Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay, now we're going to talk about the assignment. So before the session break, we talk about the general approach of doing the assignment and where you may start. So basically, if you have followed the instruction, you have on the stage of understanding the imputation credit system in Australia, you understand how tax is applied to income or realized capital gains. So all of these are background information to make any financial advice, especially for the case in your assignment. You do need understanding on this basic background information. And also, if you have followed the pace of the tutorial and the lecture, you have basic understanding of modeling in the asset allocation or funds management context. You know how to calculate returns, the difference of different ways of calculating returns, and the ways of measuring a portfolio return and risk. And also, from week 5, you should have had a fairly good understanding of the approaches of asset allocation. So basically, in addition to the traditional mean variance optimization, we have introduced a few alternative asset allocation approaches. They, on different aspects, they sort of complement the traditional asset allocation of mean variance optimization. So with this knowledge available and skills developed so far, you should be okay to approach the assignment. And also, for the requirement of the assignment, you are required to analyze, at least have one quantitative model. The other model can be quantitative, either quantitative or qualitative. For instance, fundamental risk approach, it's at your choice. So the required elements from the assignment will be the models, the quantitative models, and the final asset allocation report written for your client. These are the very general requirements of the assignment. And the marking of the assignment. I would like to highlight this at this stage to let you know that your assignment is not going to mark against a set of correct asset allocation. You are given the same expected returns, same historical data, but eventually you're going to have quite different asset allocation advice for your clients because you have different beliefs to interpret the objective and the risk constraints of the same client. And then you're going to make your own judgment of the asset allocation. So all of this will lead to quite different financial advice for the same client. That's what I'm happy to see actually in the class. That's actually the case for a lot of students who believe that, okay, I run the mean variance optimization and that's the asset allocation. That's not the case. Think about this. You are given the same expected return, same historical returns, and you're going to adjust the historical returns in the same way, and you're going to run the mean variance optimization in the same way. Eventually, you're going to get the same set of asset allocation. That's not the case in practice. And that's not the reason that your clients would like to pay $5,000 to you for that financial advice. They want your insight into the asset allocation problem, and they want your judgment. They want your reasonings. So don't believe that asset allocation should be determined by the model, by a fancy model, by some very fancy manipulation of the quantitative model. No, asset allocation is eventually a decision of the financial advisor or financial planner. So don't be afraid of making assumptions. Don't be afraid of having some adventures. If your asset allocation is different from other groups, it doesn't mean you are wrong. You just have different beliefs. You have some different judgment in the asset allocation question. Unless you have a multi-asset diversified portfolio, you should be okay to pass the assignment if your report is written in a reasonable manner. So you're not going to be penalized because you are adventurous, you do additional research on any particular segments of the market. You're not going to be penalized because of you make some not well thought opinions. That's not the case. That's my intention to give you the opportunity to make your own judgment, make your assumptions, to have some adventures in solving the problem. So the reasonable asset allocation means that, I'll make it clear here, the reasonable asset allocation means that it's diversified across the asset class and you do consider the investors' constraints, the objectives in your asset allocation. For example, if you have an asset allocation of 70% in Australian equity and 20% in Australian property and the rest of them in Australian bond or whatsoever fixed income, that's not a diversified portfolio. It still has concentrated risk. And if you have a portfolio proposed, like 60% in property, 40%, like 20% in emerging market, 20% in Australian government bond, that's not a reasonable asset allocation. If you run a quantitative model, given the tracking error, given the other constraints, you'll never get such asset allocation in this way. So keep this in mind. I do define a boundary. You might have some adventures, you might test your own ideas, but eventually you will have a diversified portfolio and most of the investors' constraints, objectives can be satisfied. If you have doubts over anything, come to see me. Your tutors won't be very useful on this regard because they may help you on some basic things like calculating returns, calculating some portfolio measures, but they're not going to be very good at interpreting the reasonable asset allocation or give you some advice where you might go ahead with your own research or judgment. So come to talk to me when you have questions. In this lecture, this workshop, we're going to have a look at two quantitative methods to come up with an asset allocation. The first one is a bootstrap method. On Wattle, you will have this spreadsheet available. So this spreadsheet is based on unadjusted historical returns. You have to adjust your historical returns based on the given expected returns in your assignment. So have a look at the related tutorial exercise if you don't understand adjusting historical returns. Just for simplicity, I don't adjust the historical returns. I believe you have a fairly good understanding of Bootstrap so far. Bootstrap is a very powerful quantitative method in finance, especially in funds management and asset allocation. The only thing that you should be very careful is that we assume this outcome of portfolio returns or asset returns are independent, so that you can do the random drawing and the calculation of the risk measures here, like probability of loss, standard deviation, are something valid that you can rely on assessing the portfolio risk. If you still don't understand why they should be independent, come to talk to me. So this is the spreadsheet you should have done in tutorial 2. So basically, we assume that these returns of the investors of the portfolio are going to be a random outcome in the future. Any one of the outcome of the portfolio is going to have the same probability distribution. Or in other words, given this historical performance of the portfolio, the next period, next year portfolio performance can be any one of these at the same probability level. So that's the idea of doing Bootstrap. It's through this structure to the right that you generate random numbers so that you can link the random outcome to one of the portfolio outcome here. Something I would like to remind you is that these portfolio returns, you will see I have highlighted a few portfolio returns of 53%, 38%, and the global financial crisis of 15%. So how do we look at these extreme, so-called extreme returns in the history? Are they outliers? Shall I get rid of them or replace them with a historical average? That sometimes we do have this manipulation of historical returns. We get rid of the outlier when we run regression. In some statistical package, you can calculate the weight, the influence of that potential outlier on the regression line. So you have some better idea, quantitative idea of how much that particular point has on the regression line, the coefficient and the alpha. So in this case, we do not delete these extreme, so-called extreme returns. The idea of doing Bootstrap is to believe any one of these outcomes will be at the same probability to happen in the future. If you do want to delete anything from here, you got to ask yourself, do you really believe that we're not going to have another global financial crisis that makes my portfolio return to be negative 15%? Are there going to be some time in 1985, in 1986, that my portfolio is going to have a return of 53% over a year? If your answer is no, there's no chance that this is going to happen, you probably can delete this or change the data points here. But we are human beings. One financial crisis is going to be followed by another financial crisis. There's no way that the financial market is free from financial crisis or such dramatic event or dramatic stock market slide like this, especially like this 15% is nothing compared with Great Depression. So if you do want to play with the data a little bit, if you do have some strong opinion of the probability of these returns, you might do something with the probability. So these are the realized returns. They did happen in the past. You probably want to reduce the probability of these events to some extent you feel comfortable with. For instance, the 53% return over a year, you might reduce that probability to 2%. And if you believe, okay, something like the global financial crisis is going to happen anyway at the same probability as any other returns, don't touch this. But with the reduced probability of some extreme returns, you will see the total probability is reduced to 96.86%. So this has to be 100%. With the reduced probability, you have the choice of distribute that evenly to all the other years. Or you may increase the probability of any particular portfolio return over here. But usually the practice is to reduce some probability of some returns and distribute this probability evenly to all the other years, so that at the end, you're going to have still 100%. That's how you might do your own, add in your own flavor of the bootstrap process. Be very careful if you want to delete anything from here. That's one method of doing bootstrap. You bootstrap to the random drawing of the portfolio outcome. So how can we use this to generate portfolio weights? So these portfolio returns are linked to the weights or returns in these spreadsheets. So in the bootstrap, you're going to calculate the portfolio outcome and risk measures in this way. And you have to observe, okay, the mean return is at this level, 5-year compound return. That's something we're looking for. So have a look at this, the portfolio return per annum. Does it satisfy the investors, the client's objective? And have a look at the risk measures. Are there any risk measures violating the constraints requirement of the clients? If you believe all of these risk measures are fine, there's no tracking error here, you've got to have a look at the probability of loss, tracking error, illiquidity as well, because it's one important risk constraint. And with all of these evaluated, you go to the weighting of your portfolio, which are linked to the portfolio outcome. You change the weights marginally, and that will change the portfolio return and risk measures over here. Compare with the first round of your bootstrap. Do you improve your portfolio marginally in a way that you desire? If not, go back to the weighting and change again. So the bootstrap is a process of iterations. And every time you generate portfolio outcome, the returns, all of the risk measures, you copy paste the outcome to another table to leave it there for comparison. And until you do the iteration, until you come to an asset allocation that you are happy with, that most of the risk constraints and expected returns can be satisfied. It's possible that some of the risk measures cannot be satisfied, and then in this case, you have to prioritize which one is the most important one, and which one comes second, and which one I can relax a little bit. Because these forecasted portfolio return and risk measures, they are just based on the adjusted historical returns. It doesn't mean that the future returns are going to be realized in this way. Your job is to have the asset allocation that will help the clients to meet their objectives and constraints at the best chance. It's not a requirement. You have to hit the target. So that's one way of doing the bootstrap on the portfolio level. Another way to run the bootstrap analysis is to bootstrap the asset returns. So here I have the returns of each asset class, and to the right of that spreadsheet, and you can do the random drawing from each of these asset classes, and then calculate the portfolio return. So that's another way to do bootstrap. It's very close to the, not very close, but it's similar to the ideas of stochastic asset model used in practice by the financial planners or investment advisors. So with the stochastic asset model, they allow all of the parameters, all of the asset returns to be random outcome. And then in this way, with the help of statistical package, you can generate a distribution. With the use of Excel, you're not expected to generate a distribution. If you want to try, you can do it, but it's not really that necessary. So the idea of doing bootstrap to help you to understand how this can be used in this context and get your hands dirty and do some extra work on the returns. So that's the other way of doing bootstrap. Another quantitative method is by using the hypothetical rolling returns. So obviously, with the hypothetical rolling returns, you're going to decide data interval and sample period. Here, I'm just going to use the whatever is available here, and they are in yearly interval. Obviously, from the assignment, the investor would like to measure the portfolio outcome, the returns, the risk measures in 3-year review period. So that's usually the case that investors, they hold the portfolio for a very long term. They don't wait until the end of holding period to evaluate the portfolio performance. So periodically, during the entire holding period, they would like to have some understanding of their portfolio performance, and especially they want to find out the risk profile of their portfolio. So that's why we introduced the concept of review period or review window. For your clients, they want the portfolio measures to be calculated in 3 years of time. It's reasonable for long-term investment horizon, given that over 3 years of time, there might be some changes with the investment universe, the investment opportunities, and the characteristics of some asset classes may change. And there might be some changes with the investors' risk preference, their objectives, and it's reasonable window, 3 years, to measure these changes and have a look at the implications if there are any changes on the portfolio outcome. So it's different from the mean variance optimization example in the tutorial, which uses one data interval. That's actually the assumed assumed review period. With your assignment, you have to calculate the 3-year returns of the portfolio and calculate all of the risk measures based on 3-year returns, because that's the horizon that your clients would like to measure the portfolio performance and risk. So in that Excel file, I'll give you an example of how these returns can be calculated. To the right of the total return index, I calculated the simple period return. That's the return investors would be able to receive every year. That's for the yearly return. They construct the portfolio at the first day of the year and sell it on the last day of the year and buy all of the assets again on the first day of the second year. So that's what they're going to realize over the entire period. And to the right, we have the continuously compounding returns. We have discussed the difference of continuously compounding returns and the period return, the simple returns, and the use of them. So in modeling, working with continuously compounding returns is flexible, and it gives us the flexibility in modeling to change the review window easily. With the continuously compounding returns, the 3-year total return will be just simply the sum over 3 years based on continuously compounding returns. Of course, the sum of continuously compounding returns is not the realized return over the review window, the 3 years. So that's why I take exponential of the continuously compounded total returns over 3 years minus 1 to convert it to the period return or simple return. That's the return investors is going to receive after holding that portfolio for 3 years. That's actually the investment experience of the investors. Alternatively, to the right, it can be calculated in this way. So you just use the total return index over 3 years and calculate the total return over 3 years. The two ways are going to give exactly the same return. There are some flexibility working on that's the continuously compounding returns. With that, I can easily calculate my portfolio performance over different review period. For instance, the client in your assignment wants to have the portfolio performance over 3 years. What if you want to have a look at the portfolio performance over 2, 3, 4, 5, 6 different review horizons, different review windows? Using continuously compounding returns, you can generate these returns easily by changing the formula of the sum here. And also, it's very convenient to generate geometric mean. We have discussed the difference of geometric mean, arithmetic mean in terms of measuring portfolio returns, and especially when we have a funds management or asset allocation problem, we usually have funds inflow, outflow. There will be some wealth effects involved when we calculate portfolio performance over multiple periods. We prefer the geometric mean over multiple periods because it's an average portfolio return over time. But the arithmetic mean is an average over the value of the portfolio over multiple periods. So it's very straightforward to calculate geometric mean from continuously compounded returns, and that's 25%, based on 3-year returns. It has to be the 3-year returns. For comparison purpose, you may annualize that, the total return, the average 3-year return of the portfolio, and you might compare this with the investor's objective to see if you have helped the client to achieve the client's objective and other constraints as well. The standard deviation, it has to be calculated based on 3-year returns as well. We have learned extensively of the horizon effects in several tutorial exercises and also discussed in lecture as well. So annualized 3-year standard deviation is different from the standard deviation you calculate from yearly returns. Hopefully, most of you understand the difference so far. So these highlighted numbers are the correct or the appropriate portfolio measures you are expected to generate for your client. Not the returns based on yearly returns, not the standard deviation or probability of loss based on yearly returns. These are, if you do calculate the portfolio return and standard deviation risk measures based on yearly returns, you are assuming the investor's investment, the review period is 1 year, which is not the review period of your client. So that's basically the most common mistake in the past students will have in their modeling. That's the common problem of calculating returns. Another common mistakes in the modeling is actually related to the mean variance optimization. In your tutorial exercise, we have this theoretical world of modern portfolio theory with the assumptions of efficient market, single period model, and investors only care about risk-return trade-off, and that's a long list of assumptions. That's why we might safely run the mean variance optimization to generate the efficient frontier and choose that market portfolio. In practice, investors have objectives other than risk-return trade-off, and in practice, not all investors evaluate the performance of their portfolio against a risk-free rate. So that means when you run the mean variance optimization for your client in the assignment, you do not try to maximize the Sharpe ratio, and you do not try to minimize the portfolio variance, because these are not the objectives of your clients. You may run this outside your mind spreadsheet to get some ideas of the efficient frontier if you like to have a look at, and have a look at when you introduce a new asset class, how the efficient frontier will change. Change the slope? Does it shift? That probably will give you some good exercise in terms of understanding your investment universe. But by no means your clients who like to maximize the Sharpe ratio or minimize the portfolio variance. What's the client's objective? What's the client's objective? Anyone remember that? So the client wants to maximize the portfolio return, and the return is better to be 3% above the expected inflation. So that's the performance objective of your clients, not minimizing variance or maximizing Sharpe ratio. There's inherent assumption of maximizing Sharpe ratio that you use the risk-free rate as the benchmark. You want to generate much higher, as high as possible excess return over that risk-free rate given each unit of portfolio risk. That's not the return objective or risk constraint or benchmark for the clients. What's the benchmark of the client? Is it risk-free rate? The benchmark comparison portfolio. because there's a tracking error requirement. I don't want to be too much away from that peer group asset allocation. So these are the basic understanding of investors' objectives and constraints and how you might incorporate this into your modeling. Has anyone run the mean variance optimization yet? Anyone? I'll point a direction if you have run that exercise. So the mean variance optimization can be done based on the hypothetical rolling returns of the portfolio. Another way of doing the mean variance optimization is to combine this process with the bootstrap. You may think about this, and you probably will have the elements of bootstrap and the mean variance optimization at the same time in one quantitative model. It's just your choice. If you have any questions on this modeling, come to talk to me. Any questions so far? Have you done any modeling yet? I'm just curious. Up to this point, you should be doing something, no? Still no. So the data selection. With the tutorial discussion, lecture discussion, and also mismatch exam, you should have some fairly good understanding how to choose the data interval and the sample period for your client. So these are the considerations I'm not going to repeat. One thing you might feel not very confident is that, okay, shall I include all of the assets in one go? Or I should start from a few asset classes for the base analysis. Actually, it's your choice. You may run the first run of your quantitative modeling, no matter it's bootstrap or mean variance optimization, by including all of the assets. Have a look. Have a look at the efficient frontier. Have a look at the asset allocation output from these models. Another way that to build up your insight into the contribution of different asset classes into your portfolio performance is to have a baseline portfolio that includes the key asset classes. For instance, Australian equity, world equity, Australian fixed income, and world fixed income, and cash. And then every time you introduce one new asset class into your quantitative model, for instance, mean variance optimization, and see how the portfolio return and risk will change when you introduce a new asset class. This will give you this marginal understanding of a new asset class. And also with some assets like direct property, private equity, hedge funds, with this asset, we have limited historical returns, and we do not have very much confidence in the historical returns. You might want to leave these assets to the second stage of your asset allocation analysis. So you might want to apply the two-stage analysis approach. In the first stage, only include the asset classes that you have confidence in forecasting, you have confidence of having reliable historical returns. And in the second stage of your analysis, you might exercise your judgment and, given the investor's objectives and constraints, introduce one new asset at a time to see if you might be able to improve your portfolio, return and risk measures marginally. So that's how we generate asset allocation following these quantitative methods. for any quantitative model, you have to have this qualitative judgment, because in practice, we do not just follow the models. We do not let any fancy model to dictate the asset allocation decision. Here I give you a list of reference. If you still have problem with adjusting historical returns or whatsoever bootstrap, you may go to find these references, especially in week 5 and week 6. These are something that's related to tilting or testing your ideas of asset allocation. It's going to be useful in the second stage of your asset allocation analysis. When you generate asset allocation output from the quantitative models and you want to test some of your ideas, I want to introduce gold into my investors' portfolio, how that will have an impact on my investors' portfolio outcome. So you might have some inspiration from these tutorials. Change this weighting marginally and try to test the financing source of that additional asset class. I'm not going to finance the additional investment in gold from equity or from fixed income or from property. So that's where you may find help if you want to test these ideas. The analysis method required in the assignment is at least one quantitative method, and you have the choice of another complementing and substantially different analysis method. So applying one quantitative model, for instance, bootstrapping over 2 data intervals, is not counted as 2 quantitative analysis methods. I have a list of common mistakes you might have in the early stage of the assignment. You have to avoid these mistakes and try to generate something meaningful for your client. I think I have talked about this. Okay, some other common problems I have received in the past on the assignment. Shall I include Australian cash in the mean variance optimization? Yes, Australian cash is a risky asset. There's no risk-free asset in the investment universe. It just comes with a minimum level of risk in your total portfolio. And especially your investor does have the constraint of 1% minimum asset allocation into cash. So you have to include Australian cash into the mean variance optimization and your bootstrap analysis as well. The expected inflation, to forecast the expected inflation in Australia, you might read the monetary policy statement from Reserve Bank of Australia, and they do provide a time series data of expected inflations. These are, you got to read the notes, and they come with a horizon for the next 1 year or 2 years. They have the forecast of inflation from different parties. The inflation rate, 1.3% on the homepage of RBA, is by no means expected returns. It's the realized inflation in the recent quarter. So that's probably not close to the expected inflation. Private equity and hedge funds. The backfill of the missing data is not suggested. So only if you have very strong reason to do so. Remember this, in modeling, garbage in, garbage out. If you do not have confidence in forecasting the historical returns, when these hedge funds and private equity funds, they didn't report at all, your forecast is very likely to be misleading. that will get you into big trouble in your asset allocation if you're going to rely too much on these imagined historical returns. But if you want to find out how this backfill can be done, you can have a look at the readings in week 9, have some basic ideas how you may backfill some return data. The asset allocation output is different from other groups. If that's the case, don't panic. That's not a problem at all. So when we have the output from the mechanical quantitative model, you have to fine-tune your asset allocation. And that's absolutely not one goal game. So you got to test your different ideas of asset allocation and see if you're able to improve your portfolio marginally by manually plugging in different weights within your model. And given the different priority of the investors' constraints, it's possible that you cannot meet some of the performance or risk measure targets. It's okay if most of the constraints are satisfied. If you are more adventurous and you would like to do some independent research on particular asset or asset class, for instance, property market in Australia, especially the residential property market, I have some resources provided on Waldo. You can have a look at these different aspects to understand the driver of the residential property market in Australia. If you're going to do a search, use Factiva from the library. Do not do Google search. That's too general. And that's for mom and dad investors. You are professional. You should be using something that's used by professionals. So from Factiva, it's very likely you're going to have the analysis piece from Australian Financial Review. And these are written by professional journalists in economics, in finance, in business. And sometimes you may get some coverage from the investment banks or economic consultants. If you're interested in the US data, I have that ready for you in a folder as well. Especially if you want to have access to international data or US data, no matter it's labor market, inflation, interest rate, treasury bond yield, you can go to the website of St. Louis Federal Reserve. They have over 1,000 time series of economic financial market data. If you can't find anything that you need from all of these sources, let me know. I can get it for you. Very likely I can get it for you. Okay, lastly, if you do a Google search, it's very likely you're going to come across trading economics. Do not use data from there. We don't know where they get the data. They do provide a lot of things like the P/E ratio of the stock market, the forecast of a lot of economic indicators, but we don't know the source. It might be the consensus of a group of analysts. It might be the forecast of the central bank. We don't know. So do not use this in your modeling. Use some source like Federal Reserve, Reserve Bank of Australia, or Australian Bureau of Statistics. These reliable sources. If you can't find anything, let me know. It's very likely I can get it for you. So that's the end of it. Any questions on the assignment? I have sent out a course announcement to ask for your feedback to have the assignment due in week 12. If I do not receive any objection until tomorrow, I'm going to make it formal. Okay, thank you very much.
It's like an invasion of mosquitoes.
Huh?
It's like an invasion of my students.
Yeah.
From the top.
Excuse me. A question. I use the solver to get a portfolio with, but it's too small. I don't know. It's really small.
Let's have a look at when we go outside, okay?
Okay. Go outside.
I would have to log off.
All right.